Stocks continue to trudge along here in a sideways action today. The question is, are we now have we gone sideways enough to set us up for a breakout to the upside? Or have we still not had enough of an exhale to sustain another near-term, multi-week near-term run without this one having ended yet? So we're going to break down what this past sideways week has been. And even though it's been so flat, there's been some moves. There's been some pullbacks in some areas of the market versus others. So we're going to take a look at where and what that tells us and what we can expect to see from risk appetite going forward from here. So. And then we'll take a look at a stock that is mired in its own seasonally sideways trend and talk about how to trade that. So sideways is the keyword of the day. So let's go ahead and get started. Today is Thursday, November the 14th, 2019. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the market forecast indicator. You see that we are now 26 days with the near-term line, the blue line, up above 50. And you'll notice that for the last, 1, 2, 3, 4, 5, 6, 7, 8, the last 8 days, it's hasn't been above 80. So it's one thing for us to be really strongly bullish with the near-term line in the upper reversal zone, like the intermediate line. But you notice it hasn't been. It's been more down towards the chart's midpoint, down below 80. Same down below the market sentiment line for that matter, and same thing with the momentum line. Momentum line can show, the small ranges are going to have an impact on that, but the near-term line just shows just how sideways we have been on the S&P 500. 26 days is a long time. So, and it doesn't mean that we can't get to 27. There's been, I think we saw a 31-day move back like in 2014, if I remember correctly. So it's not like it has to go down tomorrow, the blue line at least. But just keep in mind that the longer we go, the typical run 7 to 12. And you also notice like for the Russell 2000, this whole time, the near-term line has been below 50 for this past 7 days. And you look at the NASDAQ composite, we have had a dip, 2 dips below 50 during this run that we've had on the S&P. And then you look at the Dow Jones Industrial Average, it had a really big dip in between during this dip. I think this is Boeing related. But it had a really big dip during this run that brought the near-term line into the lower reversal zone. And none of these times has the S&P brought it. So it kind of just shows where we're at right now. But, again, you can't deny the strong bullish posture and the rising market sentiment that itself is almost to 80. So it's a very strong bullish market that we're in right now. And it's not a overbought bullish market. So we're not threatening like extreme overbought conditions in the least bit, similar to say like January 2018. It's more that we are just a little overbought in terms of how long this inhale has been in the short term. And again, you can stay overbought for a long time. Divergences can happen for a long time. So it doesn't have to come down immediately. But just know that a move to 30.50 is looming, right? At least that kind of move is looming. I don't think we'll get a drop down to 38%, not this much. I think we'll dip, and I think the next near-term rally probably won't get to a new high. I think we'll have some ups and downs, some chops here. But that kind of move. Now, it might, if we go up higher before we pull back, then that 30.50 might become 30.55 or maybe even 30.60, depending upon how far we move these Fibonacci lines up. But just know that kind of move, which as of right now is a 40-point move. So that's not, nothing to sneeze at here. That kind of move is just looming out there, waiting to happen. I think the issue is that nobody wants to sell off the market or sell off any of their positions before a trade deal is announced, knowing that any kind of trade deal that gets announced will be bullish for the market. So I think that's why you don't have a whole lot of buyers continuing to push us higher, but at least significantly higher after this initial thrust. but you also don't have any sellers willing to push you down the 30-50 either. That's how much people are anticipating a bullish event to occur on the market. And we all know that that bullish event is any kind of trade deal, whether phase one, whatever, right? Any kind of trade resolution being announced. You look at the market forecast on the weekly chart, and we still got one more day left. But look how strong the short-term sentiment is on the weekly chart. We've had boom, 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 6 weeks in a row of rallies off of that dip on the near-term line below 50. The momentum line is down because the ranges have been getting progressively smaller. Last week's range was 32 points. This week's range is 27 points. Again, one more day remaining in the market. So, but you can see, again, just how strong the short-term sentiment is. As you notice over here, just because it's high doesn't mean it has to dip. But you notice that we had 1 week. You had such a big rally for so long that you had this 1 week dip right there in March before we rallied for another 6 weeks. That's the kind of move right there that's looming. Now, we know whether we get it next week or whenever, we don't know, right? Because even the week before that was such a small, tiny week. It could have been either of these weeks. It just happened to be the week of March 4th. So, but just know that as we continue higher, and as day 26 turns into 27, 28, 29, 30, then that's going to be an uncomfortable move. A move to 30-50 right now will be an uncomfortable move, but it will just be the type of move that will be good for the market. So now you notice we chopped for a little bit here, up and down, and this is the kind of chop I expect over here eventually before we rallied up to new highs from what we had from what we finished March with. All right, before I look at some other charts with you, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching this on YouTube that notifies you when these videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us 2 things. Number 1, you like the video. Number 2, you want us to do it again tomorrow. So it's a quick way to give us feedback. You can do that right now while you're watching. Also, while you're down there, comment. What did you get out of the video today? We'd love to hear what you're getting out of this. Join our website at marketscholars.com. You can do that for free. There's a link popping out right there in the top right corner of your screen. That will give you access to our Market Outlook forum with other members of the community, as well as access to our market community or market commentary blog portion of our blog, among other things. Follow me on Twitter for more content, commentary in between these videos from day to day, and then join our Facebook group that we've created for Market Outlook viewers. All right, if you're watching this on our blog, I invite you also check out our Market Outlook live trade review videos where we review these trade ideas that we start in these videos and we manage them all the way to the end of the trade from day to day. And we also take a look and put on today's trade. In fact, I've already put on today's trade idea in our account in the live trade video that we do before the market closes at 3:30 Eastern time. Here's our classes that we have coming up this week. Again, remember all of our trading rooms are available on our monthly plus subscription. You can see a link right above the video. You can also get access to our live videos, Market Outlook Lives, as well as all the trading rooms, 8 different trading rooms that we have week in, week out. We invite you to engage with us on social media down here with the Market Outlook tweet and Market Outlook Facebook post. Just liking it will make sure that Twitter and Facebook promote our content to the top of your timelines. Make sure you don't miss any of our stuff. All right, back to the charts, and you can see on the long-term chart, the close that we're getting right now, we're really high, like 30.97.77 is last week's high on this, and we are trading right now at 30.88. Now, granted, we're at 30.96, but the close on this Heikin-Ashi is at 30.88, so we're pretty darn close to, depending upon how we finish tomorrow, we're getting pretty darn close to finishing with a really bullish high point. Again, it'll be another, 3rd consecutive week of closing above the Heikin-Ashi close. Not just the actual weekly close, but the Heikin-Ashi closing above the prior week's high. That's bullish. I mean, you can see we didn't get a whole lot of that over here. We kind of closed around the previous high. But that's potentially three pretty bullish weeks. Like I said, depending upon how we finish. So, and you remember, we just broke out on this 2 weeks ago. And you look at the Russell 2000, and it still hasn't really broken out. I mean, it kind of did last week above a lot of these highs, but it hasn't broken out of this whole range and gotten up to this level like the S&P has. So this still hasn't, we still haven't really got the participation here of risk appetite. Let's take a look at the three green arrow chart. Again, easily three. Well, we got the one red arrow on the MACD, and to kind of show you what that looks like on a two-line basis. Let's go to SPX here. You can see the MACD is below the orange line, but the orange line is still very high. You can see you can get those. You get those brief red arrows on the MACD, even if you're barely flirting with the 8-day, and we still haven't even crossed below the 8-day. And then you look at like how we're trading relative to the MACD on the 12-day chart, and you can see we still don't have the red arrow yet. We're well above the 12-day. So this kind of just again shows how strongly bullish we are. The NASDAQ has pulled back. Remember, the NASDAQ has pulled back on the market forecast. You see it is flirting with its 12-day. It is retesting some of these highs. It does have the red arrow on the MACD with a really, really high moving average here, higher than it's been since back here. And remember, like when you get a good trend going on the Russell 2000, that orange line can stay up here, right? It can stay up here for a while. So it's not necessarily to an extreme in the least bit to where we would expect an immediate reversal. In fact, even if we do break the 12-day in this case, the 26-day would be your next stage of support when you're looking for a reversal stages. And we're still, like I said, we're not even close to those areas yet. Now let's take a look at the intraday chart, and you'll see that the range here, it's interesting to see how the bullish move has occurred throughout most of this 26 days. It started way back over here. You notice that we had some ups and we had some downs, and then we broke up on an intraday basis here on October 25th, and then on the 28th, which is a Monday, we gapped up. And then we spent 1, 2, 3, 4 days pretty much going sideways to down a little bit. And then here on November 1st, on a Friday, we gapped up. And then again, on gap up on Monday. And then 1, 2 days of sideways action. And we gapped up here on, this would be a Thursday, on November the 7th. And then we spent 1, 2, 3, 4, 5, 6 days going sideways. So you notice it's gap up and flat and up and flat and up and flat and up and flat. Now the question is, are we going to gap up? If and when are we going to gap up again? And like I said, a move down to 352 would be down to right around this area. Would be the open of November the 1st. So to put that in context of this kind of this volume profile, that basically would get us down into this area. That brief little volume node. That's where the 20% retracement level would be. Your 30% retracement level will be into this area, 38% retracement. I don't think we get that kind of move. I think at some point in time, a 23% move is looming. And the longer we go up and the more we go up, the bigger that move is, even though it's still only 23%. And so, relatively speaking, will be small. On an absolute value basis, it might be bigger than some people are comfortable with. It might actually maybe even produce some markets in turmoil, depending upon how many of those points occur on the same day or not. Let's look at today's range, and the ranges and the volumes have just been abysmally low. Here you can see the range is 1.5 points. The volume at 52 million. The average, in fact, look at the average. The average now has hit down, and you can see it better on this chart. Look at the average here, how much it's come down from where it was even just in August. The average in August was almost 100 million shares a day, and we are now at 50 million shares a day. That's how much the volume has really dropped off. The range at 1.5 points is well below the low end of this ATR, 52-week range of ATR. We are entrenched below 1%, so it's a slow slog, grind higher to the upside. Gap up, flat, up and flat, up and flat, and that's the kind of move we're in right now. It's really boring. It's hard to trade directionally unless you find some good names, like they have been making their own moves. But from a broad standpoint, it's just up and flat, up and flat. So the last 6 days, we really haven't gained very much. This year-to-date value, after I made that thrust up, it's been right around this mark for over a week. And as a result, volatility has been really relatively low too. So you take a look at volatility, and you can see it's been hovering right around the sweet spot of the bullish territory. So that's why I say again, I don't think, like, if anything, volatility gets up towards 15. If anything, and if we do get that in the next couple of weeks, by Thanksgiving, that will still finish November with the smallest range that we've had in a long time, in over a year. And considering the extreme lows we've been getting on the VIX relative to VXV, this is bullish. This is continues to be bullish, but we're not extremely bullish to where I think, we're going to get, an intermediate pullback, much less like a market sentiment pullback. At the very least, we just get a near-term choppiness until we kind of settle out this little run that we've had, and then we continue with this bullishness. That's the expectation going forward. So what do you think? Do you agree with that assessment? Do you disagree? As always, I'd love to hear from you now. Use that link popping out the top right corner of your screen. It opens up a poll. Then hit either agree or disagree. If you click disagree, which is perfectly fine, let me know what you're seeing. What indicators are telling you that we might be a lot more overbought than what I think we are? What indicators are telling you that we are ready to blow out to the upside again? Whatever your disagreement is, share with me down below. Not just your opinion, because everybody's got one of those, but what's driving that opinion. And we don't, you don't want that drive and what's driving your opinion to be, because that's just what I think the market should be doing, right? It's, what indicator are you seeing, or what data point are you seeing that suggests something different than what we came up with our outlook here today. All right, now let's take a look at what's driving this price action. We'll take a look at the asset class comparison here. You can see long-term bonds was the biggest winner today. In fact, if I just take a look at just today alone. So we'll go down to November. We're in November now, the 14th. Just looking at today, you can see bonds started the day strong, real estate started strong, gold. So even though the market was up, almost 0.2%, it was a risk-off day. Crude oil was down, not down very much, but it was down. And stocks were relatively down, at least down compared to these other safety asset classes. But keep in mind, these safety asset classes had been so bullish, and they're pulling back, right? So they're really, in the last 3 months, you can see they're starting to really give ground. So they're bouncing up a little today because they're oversold in the short term. We have some overbought conditions in these equities. So look for some of these gold and bonds to have a little bit of a bounce back. In fact, if you take a look at the market forecast for something like gold here, gold, there we go. You can see we've pulled down to the 38% retracement level of that bullish run that we had. In fact, here, let me show you in context. There's a bullish run that we had. So we've been on a pullback. The market forecast has been either strongly bearish or with the light green shading and the yellow line, which is a reversal pattern. And that's kind of where we're at right now. We got light green shading, and if anything, we'll get a yellow line on that moving average. But you can see the trend is still bearish. We're just, don't be surprised if we don't get a little bit of strength here off of this support, Fibonacci support, up towards 1500, to the point where we might get a yellow line again, which means we're trading above a falling moving average before things then roll back over and head back down to the downside. If you look at the Bollinger Bands for the gold, the futures contract, the volume profile, you can see we have broken down. We had this volume node that we were kind of flirting with, where we broke down into this gap area. We might come back up and hit it now for a resistance, 1483, 1480, on any kind of near-term volatility chop. before we continue to fill down towards the next volume node, which is 1420-ish, right around the 50% retracement level, or the next area of support. You break that, then it's all the way back down to 1300. There's very, very little volume because we moved up so fast here. Once you break this congestion area, there's not a whole lot of volume support to keep you from coming back down into this area again. If you take a look at the dollar index, which on one hand is a safety trade, but doesn't, on the other hand, it's kind of a counter gold trade. Well, yeah, let's take a look at the market forecast first for it. We've had that little decline and the kind of double bottom bounce at support back up to the top of the retracement area, and we're not really able to pull away yet. And again, we're not going to be bullish on it until it breaks out above 98. But in terms of bearishness, you would expect there to be some bearishness during any kind of gold strength. Let's take a look at the 10-year yield, and you notice a new bullish trend, even though we've had a little pullback and a bounce in bonds to where we have a oversold short-term sentiment. There's opportunities here for yields to bounce back up. We got up to this 23% retracement level again. You can see where that level comes from. It comes from this bearish move that we had here. We got to the 23% level, close to 2%. Again, I think by the time this little run on yields is over, we'll make him run up towards the 2% plus. So that will be bullish for equities, generally speaking. But in the meantime, right now, it's TLT is bullish. TLT has hit support and has bounced off of it at the Fibonacci retracement level and is moving back up towards that moving average, towards potentially light green shading at some point once the intermediate line gets back above 20 and a yellow line. And then at that point, if and when we get that pattern, I would expect that to be a reversal pattern for bonds and a renewal of some strength for risk appetite in general. And I've shown you this chart before, but you can kind of see too, remember how broad the rally has been with lots of dark green lines and dark green shading. Well, now we've got some light pink shading and yellow lines creeping in. The yellow line on China, light pink shading here on India, light pink shading on Russia and Korea. So emerging markets showing a little bit of weakness. Dark pink shading on Brazil, even though we still have a yellow line. So a little bit of a pullback in this. Again, you would like to see, I expect that we'll bounce off of these lows, but you can kind of see where the developed markets are. They're not even to anywhere close to light pink shading yet, or not even, and further away even from a yellow line. So I think that's where the opportunity for any kind of near-term volatility is, for there to be a little bit of chop towards these rising lines. Remember, we don't have to drop to these lines. We can just chop while the lines eventually catch up to us. And that's kind of, considering we're already getting weakness in emerging markets, I expect to be some near-term weakness in the rest of these developed markets and the U.S. stocks as well. All right, from a sector standpoint, let's take a look at how the sectors performed here today. So we'll bring that chart up, and then here's the sector performance on a one-day basis. You see real estate bouncing back up, but energy still weak, and technology, consumer stocks down. But look at what's been doing really well. So these really value areas, specifically financials and industrials. Technology has been relatively strong this whole rally, but financials and industrials have been value areas. They're really taking off. And then you see what has been momentum, real estate and utilities, is really dropping to the downside. And everything else is kind of sloppy. I mean, look, there's not a whole lot of participation here. It's just this little rally that we've had really since October the 8th. If I were to do this time frame from October the 8th here up until now and do it on a daily chart. So here's the current near-term rally we have from October the 8th all the way up to these new lows. And you can see that it's financials, it's industrials, and technology, materials to some degree, energy as well, which is another value area. And it's already showing some weakness. You see discretionary and technology lagging behind, and your former strength in real estate and utilities dropping during this time, and staples flat. So not surprised to see that kind of move, but you already see some weakness in energy. And again, I would expect the rest of these sectors to show similar weakness. Not because I think we're going to turn around in these areas, but simply because they've been so bullish. Again, you inhale, you exhale, and in this case, you run out of buyers willing to buy at these really high levels. At least it slows down, and then any kind of catalyst can produce sellers simply for the sake of profit taking. Like I said, you've already seen it a little bit in the energy sector, going from what was a 7.75% gain off of that low now to less than a 5% gain. Here's what the 12 grid looks like, and you can see dark pink shading and green lines for technology and communication services, but now we have light pink on discretionary. You take a look at utilities and real estate, and they're in really bearish patterns right now. Staples is relatively flat and unable to really kind of get going. But then look at financials and industrials, materials, healthcare, very, very strong bullish postures, very strong patterns, well up above, similar to technology and communication services, well up above their moving averages. So you can kind of get an idea. The consumers, interestingly enough, a lot of the fanfare lately has been how strong the consumer has been, but those areas have been the weakest areas in terms of bullishness. The consumer, outside of even energy, was able to pop up above the moving average better than those two areas have been. So it kind of shows that we're still not quite there yet. In fact, if I take a look at, I like to show this chart here, the FANG, but not FANG as we know it, but FANG in terms of the biggest companies that we have here, and see, because they market cap weight system, you expect them to be drivers, and they haven't broken out yet. So that's kind of that next stage of confirmation of this bullishness, this little cup and handle-ish pattern you have going here. Once you get a breakout on this, then the S&P is going to be going up for a while, just as we saw on its bullishness during these few years. Now, one area that's kind of in the financial, kind of consumer discretionary, kind of technology area, but one stock that's been kind of slogging its way around too and unable to really get going is the MasterCard. So you see how sideways it is. You got a little bit of a bullish pattern here. You got a dark green shading, green line. You look at the three green arrows, and we have three green arrows, so we didn't get a whole lot of volume on this breakout move. This is where we got the three green arrows right there. You notice it's been below average, so we're not really getting like breakout type signals. You take a look at the long-term chart for MasterCard. You see we've had really good bullish posture or bullish momentum early in the year, and we've pulled back. Well, you notice when you look at a seasonality chart for MasterCard, that's kind of the trend. When I go back 20 years, you can see the stock on average has gained 25% a year for 20 years. It's a really, really good stock. And you see that most of its gains occur throughout the big chunk of the year, and then it goes sideways from about the beginning of November all the way through the end of the year into the beginning of the year. It's a really, really sideways action. So, and we know that the market itself has got upside potential, but limited because of how bullish we've been to get to this point. And we're not too worried about any downside moves, at least any significant downside moves. So that leaves us open for a stock, for the type of trade on MasterCard, where we can take advantage of the sideways action and sell a put vertical below where we're at right now. So we'll sell the 265 buy the 260, and then sell a call vertical up above. So sell the 295 and the 300. So when you look at this trade, this is actually what it looks like here. Where the break evens are, those are where the blue lines are in this chart. So if I were to hit Bollinger Bands and take a look at MasterCard, you can see that the break evens are above where we're at right there on top, and then there's your break even on the downside. So now it is at the top end of the value area, so I am a little more worried about upside risks and downside risks. But remember, again, into the end of the year, beginning of next year, the seasonality of this stock, especially a stock that's already up 48% on the year, is just to go sideways. A stock that averages a 25% return year after year, already up 48% this year, expected to go sideways anyway, and since we have more gains than normal, even more likely to not have the continuation of this upside move. So that's where a trade like an iron condor comes in play, and you can really take advantage of that and relatively high probability trade and profit from a decent return on risk, even as the stock does nothing. That's the benefit of that type of option strategy. All right, well, that wraps us up for today. As always, you've heard from me now. I want to hear from you. Let's keep this conversation going in our Market Outlook forum. There's a link popping out right there in the top right corner of your screen that will take you there. There's also, if you hover over Market Outlook on our website, a menu will open up, and you'll see a link to the Market Outlook forum there as well. You'll also see a link to the archives and a link to the Market Outlook Live video too. Again, thank you very much for watching. I appreciate the time. Remember to hit the thumbs up icon, comment on the video below, subscribe to our YouTube channel, follow me on Twitter for more content in between the videos, and join our site at marketscholars.com, as well as our Facebook group that you saw the address earlier. So again, thank you. Have a great rest of your Thursday night, everybody, and we'll see you all next time.